Well, welcome to breakfast, and this is the inaugural QEO of the year. We've already had a bit of volatility in the last couple of months or so, so let me take you through sort of our take on what has been going on and what is going to happen over the next year or so. So, kicking off, I'm going to have a few slides here on sort of the current state of the economy. I think it's useful at the start of the year to do a bit of a recap in terms of what's going on. I guess the first thing I'll kind of point out here is that the economy itself really is not really going anywhere right now. We had a bit of GDP data before Christmas where the stats actually revised the history as well as told us about where growth was in the third quarter of last year. And that basically suggested the economy had gone nowhere for over a year and went backwards in the third quarter. So that's not really telling you a very strong story in terms of sort of like the level of economic momentum. But one of the kind of curious things is there that not all the data is uniformly negative. So on the right-hand side of that chart here, you can sort of see that business confidence in particular, abstracting even from some of the headline measures to some of the sort of measures that we traditionally think are associated with the level of GDP growth. They've been bouncing for sort of 6 or 8 months now. So the kind of question is, well, what does all that mean? And I thought I would ask you guys that question. Business confidence, is it up because the economy is actually stabilising and maybe improving, even though that data was a bit suggestive that wasn't the case? Is it because the new government, is their policies really going to kind of help your business and as a result you should expect better GDP outcomes? Or is it that inflation is lower and stabilising and costs are sort of more under control and particularly our interest rates coming down? All right, we seem to have stabilised there. So that's kind of interesting, isn't it? You know, it's the lower inflation, the potential for interest rate cuts, notwithstanding some of the volatility you would have seen in interest rate expectations in the last few weeks. One of my peers out there was suggesting that interest rate cuts weren't the thing to kind of like worry about in particular. But also the sort of idea that the new government might be helping as well is certainly one of those things that's been in the vernacular. Let's park the answers to that question until later in the presentation when we talk about what our forecasts are and kind of like what that means. And with respect to the economy, one thing that you can see that's quite remarkable is the retail sector is really weak out there. Retail sales volumes, so the volumes of stuff that people are buying have actually gone sideways now for, I think it's like 6 quarters, I think. So, that's basically unprecedented. When I asked the team about this, I certainly couldn't remember such a flat period. We have to be a little bit cautious about interpreting that because globally there has been this shift away from goods to services, and retail trade predominantly picks up goods demand rather than service demand. But nevertheless, that's telling you a story that economic momentum here is pretty flat. And indeed, also in the business sector, we see a similar sort of story. Both the services sector and the goods sectors are weak, pretty cyclically weak at the moment. Services sector is slightly outperforming. But generally, both of those are all consistent with the idea that the economy is going flat to backwards right now, and that's what we have in our forecasts for the next few quarters or so. Globally, the business environment is still not very conducive to activity. So, in the last sort of 3 or 4 months or so, we probably haven't changed our view of the global economy that much. It's still a very muted outlook for global demand. There are parts of the world that are doing better. The US economy in particular has been doing really well. The Chinese economy has probably performed a touch better than the worst expectations that were going on through the second half of last year. But in general, most parts of the world are labouring under the same sorts of pressures the New Zealand economy is, which is basically that high interest rate, still high inflation, declining, but basically we're all going through the hangover after the party that was had after that kind of COVID period. One of the really interesting things in New Zealand, and we do see this in a few other jurisdictions as well, is that population growth, and in particular net migration, is historically strong right now. And that really is helping kind of like put a bit of a floor under the absolute level of growth. So even though these growth outcomes are not fantastic, they would be a heck of a lot worse if we weren't seeing sort of 2.5% to 3% population growth that we're seeing right now. And if you look at it, there's a historically, unprecedented flow of foreigners coming into the country, but at the same time, there's a decent sized flow of New Zealanders leaving as well. Largely the story there that we kind of like put that down to is the reversion to norms after that kind of COVID period where people generally weren't able to travel. And in the case of New Zealand, there were such significant skill shortages, there was a desire to bring labour in from offshore. But we're still very much kind of surfing the wave of the peak of that migration cycle at the moment. And we think that how this cycle evolves will actually be pretty critical in terms of how the economy behaves over the next year. Which brings us to the next question we have here is, with respect to immigration, one of the topics that's been on the agenda is whether the government might potentially tighten immigration settings. What's your opinion on that? Do you think that's going to be tightened a little bit, not really at all, or do you reckon they might make a significant change? Yeah, so that's quite interesting, right? So a little. It's probably not a bad call, to be honest with you. I mean, one thing about kind of like immigration settings is they're actually a little bit difficult to actually precisely use, certainly to sort of like manage the economy. But it will certainly be the case that to the extent to which changes in settings do occur, they're probably not really going to impact the economy for another year or so anyway. So probably what we see in the next year is going to be a reflection of perhaps what happens in the labour market here, what happens offshore. But it is interesting to see there that the opinion is that we're probably still likely to see the sorts of trends in immigration in the foreseeable future that we've seen recently. So if I look at that, one of the kind of like big impacts that immigration is having on the economy is through the labour market. And you can kind of particularly see that in the behaviour of job ads, or just frankly in the volume of applications per job recently. A couple of years ago, this quite severe shortages of labour in the economy meant that there was no staff available. People were frantically trying to get staff. That situation has now more or less totally gone away now, at least in many industries. We see that in the level of job ads. You see there that it's come back to probably below trend levels now. We also see it in more broader measures of slack in the labour market as well. That unemployment rate has drifted up 4%, still a relatively low rate, but it has moved up quite noticeably from the low levels it got to about a year ago. And measures of underutilisation in the market, there's people that could probably work more if they had the opportunity, that's also drifting up as well. Most of these measures are still probably a bit below long-term average levels, so there is still a bit of tightness in that labour market, but it's certainly moving in the direction you would expect given the significant interest rate rises that have been going on. But because that labour market still remains relatively tight, it's still the case that wage growth is still fairly aggressive, certainly quite a bit higher than what would be consistent with having inflation somewhere between 1% and 3%. It's quite noticeable in the public sector. Look at that public sector wage growth chart there, that's where the pay rises were last year. But even private sector wage growth is pretty decent, and the most recent data that we got out on this about a month ago did surprise everybody at just how strong wage growth had been. So what that means is that even though there's been a significant amount of supply of labour come through into the labour market from migration, it's largely met demand. So as a result, we have not yet seen this wage growth come off quite significantly. So that brings me to another question of you. What do you think about how easy it's going to be to control wage costs over the next year or so, compared to last year? Do you reckon it'll be easier, about the same, or maybe even a bit harder? Well, I ask this because this is probably going to be one of the key variables that will impact the speed at which inflation comes down in the next year. Well, that's all looking pretty encouraging. I mean, that's our forecast as well. I'm going to show you my forecast in a few slides, but we think that given that change in the level of labour market slack, the reduction in job ads, the fact that there's still really significant supply of labour into an economy that looks like it's flagging in terms of total demand. It's going to be it should be a scenario where we do see much lower wage growth than we've seen in the last couple of years. But what about the housing market? That's the part of the economy everybody really cares about, right? I mean, New Zealanders love the housing market. You can't be a New Zealand economist without having a view on that. Well, one of the interesting things about that is, okay, there's been a lot of people coming into this country, but for the last 3 or 4 months or so, maybe even 5 months, that housing market has really gone sideways. Particularly sort of like at a national level, some sort of sub-regions have done a little bit better than others, but generally it's kind of confounded some of the expectations, certainly that we had a few months ago, that we might see a slightly stronger performance than that. Because we had seen decent growth in house prices from around about the middle of last year to about September or so. Activity in the housing market's really depressed. Even the real estate agents are telling us that they've got many more houses than they have buyers right now. So that doesn't necessarily bode very well for prices in the short term. The other thing that's going to impact the economy in the next year or so is what fiscal policy does, and that's kind of like one of the key sort of things that this new government might influence the economy as we get through into the next fiscal year. I mean, one thing about the fiscal situation is that it is actually deteriorating right now. When the Treasury gave us that update of where the fiscal position was just before Christmas, they had to add a couple of $2 billion on to the deficit for the next couple of years, reflecting the weakness of the economy. They also added a bit more costs in to do cyclone recovery as well. So, all of these things are basically meaning that path to surplus looks further away than it did, say, 3 or 4 months ago, and a higher debt profile associated with it as well. And that's something that's of interest, I think, to the Reserve Bank, because they're kind of hoping that for the next couple of years, fiscal policy will be really supportive of monetary policy, that it'll actually help slow the economy, reduce inflation pressures, and mean that interest rates have the potential to fall at some stage. And of course, the real kind of big news that we've been focused on the last few months is with inflation, which on a headline basis has been falling relatively quickly, actually, which has been quite good. Particularly focused, though, on those areas of the CPI that are tradable, that are related to, say, commodity prices, foreign supply chain restrictions that emerged during COVID. Most of those things have actually seen quite a bit of disinflation or even outright deflation go on in the last few months. That's all disinflation that was expected to occur, but it just probably came through maybe a quarter or two faster than what we might have thought a few months ago. But underneath it, though, even though that's a really optimistic story, annual inflation, 4.7%. I mean, one thing to keep in mind there is 4.7% is still over 2 times the Reserve Bank's inflation target, the mid-range, so it's not a low inflation rate. And underneath it, we still see really elevated domestic inflation pressures. Some parts of domestic inflation, like the cost of building a house, have actually come back to more normal of inflation levels now because a lot of the supply chain issues that were really plaguing that sector have disappeared. Think about the GIB crisis, for example. That's not there anymore. Labour's more widely available. But outside of that construction sector, inflation pressures are still peaking. So think about your Netflix bill, your power bill, your rates bill, your insurance bill. Your insurance bill especially is a pretty big deal right now and probably is going to continue to be. So that tells you that, this economy was pretty overstretched a couple of years ago before this interest rate cycle started, tightening cycle started. And it's still working through that as we go through, even though this economy is pretty weak. And that's why the Reserve Bank continues to be pretty cautious in terms of certainly thinking about cutting interest rates. They were pretty clear when they did the MPS last week that the discussion of rate cuts isn't even on the table right now. And that's why. And all of that means that annual core inflation, all the core inflation measures are still really elevated, still miles above the target range, certainly miles above the midpoint of the target range, certainly making progress in the right direction. Hence, the concerns about interest rates needing to rise that were flying around the markets a few weeks ago haven't really been borne out in this Reserve Bank, because they're looking at things like this and going, well, at least things are moving in the right direction. But it's certainly not something to be very relaxed about if you're a central banker. So that gives me one last question for a little while is, how easy do you think in your business will be to pass on costs in the next year? Because that's going to be pretty critical in terms of what the path of inflation is going to be. Harder, easier, or about the same? Well, I think Adrian will be very encouraged at that 76% number. To be honest, some of the surveys have been a bit mixed on this point. There's pricing intention indicators from some of the QSBO, and the ANZ has a survey as well. Those have been stuck a little bit in the last couple of quarters. Potentially tell you a story that people might still be trying to push price increases through. And I think that there's probably an element of that. That's why those services sector, sort of like non-tradables inflation pressures, are still quite strong. That's why the insurance company feels capable of sending you a bill for another 15% this year, because they reckon you might pay it. All right, so what do we think in terms of, asked you a lot of questions about what you guys think about it. What do we think about what's going to happen next? Well, it's still a very low growth outlook. This is the sort of average over the next few years is getting down towards, it's under a third now of the pre-COVID average. So that's definitely below trend. It's not outright recessionary, although very much dicing with recession, I think, given that you've basically had, we've got a negative quarter. Last quarter, we've got zero in for Q4, so you can flip a coin on that one. That could easily be negative. Remember, we had a small recession measured at the start of last year as well, so 2023 was not a flash year for growth. So, we're basically, that's that payback that was for the stronger period you had post-COVID. But on a per capita basis, growth is actually obviously really negative, because we've got that strong population growth. So you got a little bit of GDP growth, quite a lot of population growth, less per person going on, and indeed consistent with the worst of the cycles we've seen in the GFC and post-COVID in the last 20 years. No, not a strong situation. With respect to migration, and that's relevant to that question I asked you before, we do continue to think that we're surfing the peak of the migration wave. We don't think that the annual total of migrants is going to keep growing from this point. We think it should start coming off. We've got a considerable amount of uncertainty about how fast that occurs. We've tended to take some of the stronger recent data as just being an aberration, and that we're actually going to come back to a reasonably same level that we probably thought, say, 3 or 4 months ago. But we're still anticipating that in the next few years we'll see above average net migration and population growth. Some of that is well justified by the fact that there's still quite a lot of arrivals and visa applications coming through there. So at the moment, at least, foreigners are feeling that there are still opportunities in this economy. Something that's really going to slow the economy, or should slow the economy, is our expectation is fiscal policy will be tighter in the next couple of years. Remains to be seen in the budget this year exactly how tight. The Minister will be updating with her budget policy statement at the end of the month, so we'll get an idea about what the kind of key metrics are. We suspect that they will continue to want to target a surplus over the next 5 years, but unfortunately, because that fiscal situation has been deteriorating, it really looks like 2028 has become the new 2027. Before, up until recently, 2027 was when we were supposed to see a surplus. We don't think the government will necessarily find that so easy to show this time, unless they make some significant changes. And indeed, on our own forecast, we even think there could be a surplus in 2028. Does raise some questions about whether things like tax cuts, for example, can happen as fast as what we're campaigned on. or whether expenditure needs to be further trimmed, although I will say that, at the sort of cost reductions that are currently being sought are pretty chunky right now. And whilst they could be sustained for a year or so, or two, we're not so sure they'll be restrained for sort of 3 or 4 years, particularly given the population growth pressures we see. Interest rates are going to continue to constrain this economy, although the good news is that we're really through the boost phase in terms of the impact on that on household budgets. There was a really big rise in the effective amount of interest households are paying last year. There's a bit more to come, something in the order of, say, 50 or so points based off where current interest rates are. But, we are getting to the flatter point of the curve now, and that's kind of consistent with, Adrian Orr's kind of perspective that it's about 18 months after the last rate hike before you see the peak impact on the economy. Last rate hike was middle of last year in May, so second half of last year, that's when it happens basically. Makes sense to me, but not as big an adjustment as we've had to deal with in the last year or two. Our house price view is that because it's been flat in the last few months, we think it'll continue to be a bit flat for the coming period. But because that population growth is still so strong, and the rental growth is still so strong, and even more recently with the announcement of the government that they will be taking off the putting back on the interest deductibility for investors in the housing market, we do see that we will see a couple of years of above inflation house price growth. 6 or 7%, so not hitting it out of the park here. You could certainly make a case for much stronger performance than that given the really strong population growth we're right now. But it's a situation here where we've got the population growth supporting the economy, but interest rates acting to restrain it, which is what they're supposed to be doing. The labour market is going to ease, as I discussed before, so those views that you had about wage growth potentially coming off quite a bit, that's central to our view about how this economy is going to adjust. We're looking for that to increasingly occur over the next few quarters or so. The unemployment rate should drift up to 5%. To be fair, I don't think our view on the labour market hasn't changed that much in the last few months. I think the Reserve Bank's view on the labour market has had to change a bit more. But right now, things are broadly tracking as we might have expected. So, there's quite plausible in the next 3 months we see an unemployment rate that prints closer to sort of 4.3, 4.4%, which will obviously be starting to get quite close to where the sort of like neutral unemployment rate kind of like is based off our current estimates. Export prices and commodity prices have been improving a bit, but in general we still see a relatively muted outlook for those given that weak global economy view. One of the really helpful things that's been going on in the last 6 months is that dairy prices have had a nice bounce off quite low levels. It's meant that everybody, including ourselves, have had to revise up significantly our estimates for the farmgate milk price this year. We got it at $7.90 for this year and we've got $8.40 for next year. These are not fantastic years for dairy farmers, but at those levels you're getting pretty close or perhaps even slightly exceeding break-even levels. And certainly if I listen to the feedback that comes through our regional network about the views of farmers now compared to 6 months ago, it does feel noticeably brighter. So, the key question, when will the annual CPI reach 2%? Before I show you my forecast, I'd like to hear yours, please. When's that going to happen? This year? First half of next year, second half of next year, or sometime afterwards? 2%, not 3%, 2%. We're at 4.7 now. Second half of 2025, that's what the Reserve Bank says as well, so Adrian will be very happy with that. Our view, however, is somewhat more pessimistic. We do think that inflation will be below 3%. Probably in the September quarter this year. Those falls in imported goods prices, they're going to flow through into the headline CPI, so that will be good news. But because that domestic inflation is going to be is sticky and is going to continue to be sticky for a while, we think it's going to be much harder yards to move that inflation rate from somewhere around 3 to 2. We actually think it's going to take closer to 2026 based off our current modelling for that to occur. So that's a bit of a concern really, because that's quite a long period of time, and it's all obviously contingent on the other bits of the forecast. Things like the world economy remaining relatively flat, nothing serious happened to oil prices or commodity prices, no resumed supply chain disruptions. All those assumptions quite easily could be wrong. But generally the tone in that view is why the Reserve Bank remains relatively uncomfortable with the idea of talking about interest rate cuts now. They think they've got more ground that they need to cover before they can comfortably say that they're meeting their inflation mandate. Most of the action, as I've been talking about, is increasingly going to come not from lower imported goods prices or tradables prices, but it's going to come from the disinflation coming out of the domestic economy. It'll be part and parcel of that adjustment down in wage growth, the adjustment up in the unemployment rate. It's a relatively gentle rise in the unemployment rate. I'm always a bit careful to kind of call a 1% rise in the unemployment rate good, because it's not really great, but it could be a heck of a lot worse. Certainly in some of the sort of worst recessions we've seen in the last 20 or 30 years, it's gone up by a lot more than that. I noticed that in the MPS a couple of weeks ago, Adrian Orr was talking a little bit about soft landings, and I think it's the idea that he thinks he might be able to get through this without necessarily creating an awful lot of unemployment, which would obviously be a great outcome for everybody. So then moving to the interest rate implications, well, our view is that 2024 is a year when nothing's going to happen for the OCR. We've thought that for a while. We thought it from before Christmas, when the market was baying for rate cuts in March. We thought it 3 weeks ago, when the market was baying for rate hikes 2 weeks ago. I think the reality is that while that inflation outlook remains so sticky, even though the economy is really weak, there just isn't much room to move that OCR. Now, if we see something that changes that, if that economy weakens quite dramatically, and particularly if some of those core inflation pressures start coming off a bit faster than we expect, then that opens up the potential for earlier moves. I mean, I think if I tell myself what might be a reasonable scenario where something could happen earlier, certainly something in November could happen if the right conditions were to come to play. But right now, the start of next year looks like the best place to put it, and it's round about where the Reserve Bank is. They're actually even a touch more pessimistic than that, talking more about sort of middle of next year is when the rate cuts will occur. I guess the key thing though is that we don't really anticipate that when they do start, there's going to be a lot of cuts. It's going to be a gradual pace, 25 points a quarter. It's not going to be like after the global financial crisis where interest rates collapsed by, say, 300 or 400 basis points. And that's consistent with the idea that it is going to be towards 2026 before we do see that overall CPI back at 2%, which is the middle of the target range. The last thing I will say there about the exchange rate is that we do anticipate Kiwi will go up a bit, mainly because we think the US dollar will come down a bit. The Fed probably is on track for rate cuts towards the middle of this year, so that should take a little bit of shine off the US dollar. Our interest rates are going to stay at the same levels for this year in our view, so that should be generally supportive of the New Zealand dollar against the US dollar, probably supportive against the Australian dollar as well. Some of the crosses before they ultimately come off, perhaps towards later in the year or in subsequent years. So that's the point forecast. What about the risks? Well, I mean, we are at the stage of the cycle now that if I look forward in a year, it's probably getting more and more reasonable to anticipate that rates will be lower. Right now, the midpoint of the distribution is right on the tipping point where, we could have rates at the current levels or perhaps 25 points lower. But if I look at the weight of the distribution in terms of things that could surprise you to the downside versus upside, I would say that there's slightly more weight on the downside there. It's quite plausible, for example, that we could see rates, say, in 5.25% in a year's time. That would happen if we saw that real kind of easing off in domestic inflation pressures, that labour market really starts to adjust a bit faster, certainly if something nasty happened offshore in terms of a sharper global downturn. or if the government really goes to town and does something with fiscal policy that really brings forward the period in which we might actually expect to see some surpluses over the next couple of years. But the key factor there on the downside, I think, is really looking at what is the underlying, that core inflation outlook. We've already got a weak economy. I'm sure it's probably as weak as the Reserve Bank really needs it to be, but they do want to see those core inflation pressures come off before they really start looking at bringing forward rate cuts. On the upside, I mean, one of the kind of concerns is that maybe this population growth is going to lead to, say, an undesirable house price surge. And that might actually just slow the whole adjustment of the economy. The risk that the Reserve Bank continues to get surprised about how sticky non-tradables domestic inflation is, because they have been consistently surprised about that in the last year. It's why they continue to hold things back in terms of when rate cuts are going to occur. So to the extent to which that continues, it really will reduce the room for cuts and could even lead to hikes in certain situations. I would have thought it would be much more likely if overseas other central banks are coming to a similar conclusion. And I guess one of the sort of like last things to talk about is risks in geopolitical areas. And obviously you would have seen in the news some of the impact on shipping costs that have come through from some of the trouble in the Middle East in the last few months. Certainly if we kind of look at measures of geopolitical risk indices, they look like risks are about as elevated here as they have been probably for sort of like 20 or 30 years, basically getting back to periods of war. That little pink line there is a little bit hard to see, but you can kind of like see the Gaza war spike is right up there. Not as high as when 9/11 occurred in the Gulf War, but you know, you're kind of getting in that sort of zone. Markets are generally not priced for those risks. So, you know, given that the exchange rate is often sensitive to an increase in pricing of risk, that's probably something to watch in your business if you care about the exchange rate. But in terms of the sort of like broader economy, you know, one of the things where we will probably see it is in shipping costs hitting the CPI probably towards the middle of the year. So far, it's not anything like we saw in COVID. You know, we're probably talking about 0.2 or 0.3 on the CPI. So, you know, something that's uncomfortable but not a real game changer. Where it would become a game changer if these increases in shipping costs either got more extreme because the trouble in the Middle East expanded, or in particular if the impact spread to things like commodity prices and oil prices, in which cases then we'd be adding quite a lot of foreign inflation on top of the domestic inflation we already have. The other thing I'll leave you with is the other big event going on this year is the US election. We may have a President Trump coming our way again at the end of the year. Not necessarily the preferred outcome, but it seems to be the way it is. President Trump is campaigning on across-the-board tariffs because he thinks that the US imports too much and that other countries should be doing more. So, you know, some of those sorts of impacts are going to have a pretty big effect on some of our export industries. There's also the quite tense relationship that the US already has with China and that Trump is probably very likely to just exacerbate. And that kind of matters an awful lot to us because that's a fight between two of our biggest trading partners that we're going to have to navigate. And there are already signs in the government in the last year that increasingly we're recognising that, well, we are probably going to have to choose between these two one day, and we probably won't be choosing China. So that will have implications for export markets as well. So with that, I'll pass on to my colleague Imre to tell us a bit about what all this means for markets.
Thanks, Kelly. And for those who haven't come along to one of these, my job at this forum is to take on board all of that good economic information and combine it with a few other things and convert it into market thoughts and outlooks. And before we get into it, we're going to get yours first, try and make my job a wee bit easier. Where's the Kiwi going? End of June, so the idea is in 3 months' time when we come back here and talk to you again, we can compare who did best. Yes, fairly emphatic thumbs up for the Kiwi to get stronger. Yeah, a few saying the same, but few about what I'm saying too. So we don't have a major disagreement, but not that it's a bad thing. it's a market, and as long as you have a good rationale for your view, that's fine. But we think the Kiwi's going up over the next 3 months. In fact, pretty much the rest of the year and into next year, higher, higher, higher. And I'll talk about some of the detail as to why. Kiwi Aussie though, for the next quarter, probably in a downward direction. And interest rates, whether they're short maturities or long maturities, we think they're trending in a downward direction. And the yield curve slope should get steeper, i.e. the short-term rates should fall more than those long-term rates. So getting into some detail, first we always look back at the last forum we had here, and what did we say, how did we predict the Kiwi US, and how did it pan out, and what did we learn from it? We thought it would go up, and indeed it did. So I think that was a fairly decent forecast. You can see there was quite a bit of volatility. More of the same for the quarter ahead, and I'm targeting something above 63 over the next 3 months. The main reason for that is we're predicting a weaker US dollar. And as you can see, the Kiwi moves most of the time in inverse fashion with that broad US dollar, regardless of what's going on in the US, in the New Zealand economy. The US dollar is really the most important determinant. It's not the only one, but most of the time it is most important. You can see very recently it has ticked downwards. And that really, as Kelly said, has been a reflection on what the market is betting on in terms of the Fed interest rate. They're betting on fairly soon to start rate cuts, and that's going to take away the interest rate attraction of the US dollar. And so the whole world's basically selling US dollars in recent times, and that has helped pop the Kiwi up a bit. That said, Kiwi US interest rate spreads between just those two countries, we haven't actually done that well over the last 9 months, so this has actually been a bit of a weight on the Kiwi. In other words, although the US dollar broadly has weakened, we should be higher, but we're not. And the reason for that is that our interest rates have actually fallen as an advantage over the US over the last 9 months. You can see there's a trend there. We think that will change over the next 3 months and the rest of the year. Kelly and team have got the Reserve Bank first rate cut not till February, but our house call is that the Fed starts cutting in June. So that's quite a big difference. If that proves correct, then that red line's going to pop up significantly, and that will be a big support for the Kiwi US. Other things that matter a wee bit at the moment for the Kiwi US, commodity prices. The market's not putting too much store into this, but they have risen quite handily over the last few months, as Kelly said. China demand in particular has bounced back. Other things like global sentiment, you've seen the equity markets in a number of jurisdictions hitting record highs. That's helped a bit. Throw it all into the mix and you can say, well, where should the Kiwi be? Theoretically, based on all those things that have gone on over the last few months. And it should actually be a bit higher. 64 to 65 cents is current fair value. So you can say it's 2 or 3 cents undervalued, which again is consistent with our view of a medium-term rise in the Kiwi US. So bullish Kiwi US is the house view. Kiwi Aussie, near term. First of all, looking back at the last 3 months, how do we go? We got this one wrong. We thought it would fall a bit. It actually rose. What did we learn from that? We put it down to the China factor. Or market sentiment around China was quite negative over the last 3 months, as it has been for a while. It has, though, picked up in very recent times, particularly since that their 5-year National People's Congress with lots and lots of nice plans and even more stimulus. And there is, you'd have to say, a slightly brighter outlook over the next 3+ months for the Chinese economy, and that should benefit the Aussie more than the Kiwi. So that's one reason. The other reason, though, is that for yield spreads, we have lost a lot of attraction relative to the Aussie, and the cross hasn't actually caught up. You can see there's quite a divergence between the two. Yield spreads are normally quite a powerful determinant of the cross. So if nothing else, you could say that there is scope for the cross to catch up to the yield spreads and fall over the near term. On to interest rates. Short and long term, we think they're trending downwards in anticipation of this easing cycle. So we're calling the 2-year swap a bit lower. And I'll really emphasise a bit, and I'll also emphasise in a very raggedy fashion. And the reason for that, firstly, the bit. Why just a bit? You can see here market pricing in black is considerably below the Westpac forecast and the Reserve Bank's forecast of what the OCR will be in over the next few years. The markets, you could argue, gotten ahead of themselves, but it always does this because that's what they're incentivised to do, is to make money and bet on the next cycle, which is an easing one, and get their bets on early. So they'll always jump the gun. They'll be wrong a few times. Eventually they'll get it right, but they're not going to stop doing this. So this is going to be the direction of travel in the markets. It does, though, mean that they're looking a bit stretched at this juncture. So the markets have priced in a 100% chance of a rate cut in October, another one in November, and another one in February. All 100% chance. They're very, very confident of this. Compare that to Kelly and team saying, no, the first rate cut's going to be in February. So it means that the scope for the market to push it even lower and put bets on at these low levels is probably quite reduced. You have to say that from here, any direction of travel downwards is going to be quite slow. In terms of the volatile bit, why do I say quite ragged? This period of on hold by the Reserve Bank preceding an easing cycle will be the longest in OCR history, which started in 1999. These are all the cycles of relevance. You can see if we're right that the first cut is going to be in February next year, it's going to be roughly twice as long as any other on-hold period. This is a very long period for the markets to get shocked in both directions, and sure as eggs, you're going to get surprises in both directions. You're going to get spikes, and you're going to get good information which goes against the market's view and positioning, and it's going to cause all sorts of spikes, and in both directions. So I think there's ample opportunity to see a lot more volatility in interest rates than we have typically seen running into an easing cycle. So bear that in mind. That's actually a good thing, because if you want to get something done, these volatile spikes in both directions give you opportunities to get stuff done. And I'll finish off by something related to that. Converting the Westpac economic forecast for the OCR into term swap rates, we come up with these sort of numbers, and we can compare that to the actual market swap rates prevailing at the moment. They're actually not a million miles apart. That's the first observation. Sometimes they are quite different, but not so now. I'd probably pay more attention to the first 3 or 4 years. The further you go into the future and rely on something like an OCR forecast 5 or 10 years ahead, you've got to say there's a lot lower confidence in those ones. But certainly the first 3, maybe 4, they're all pretty close. The 2-year probably sticks out. What would you do with that information? You would say that if you had to hedge right now, or fix your rates right now, that the swap rate is not expensive relative to the Westpac economic forecast. It's about 20 basis points cheap. So that may or may not be useful. And I'll close on that point, and we'll open up to Q&A. Thank you.